Good morning and welcome to a What's Up with the Market, market status update. Second one for the year, and a few things have happened since, in fact, it's the third one for the year. A few things have happened since I did the last one on the 17th of January. So we'll get into that and we'll keep the questions until the end. Before that, I'd just like to remind you that none of this analysis that I do in this session is used in SPA3 Investor or SPA3 Trader, our two mechanical systems. And also none of this analysis is used to make any decisions in the ASX and US portfolios, public portfolios that we run. Two of them unleveraged are with real money, and the SPA3 Trader ones are not with real money, but they don't use any of this decision making. None of the decisions that we make, and any of those are sourced from any of this information that I'm going to provide today. And I use none of this analysis in any of my personal portfolios. I'm a mechanical trader and I precisely follow the rules of the mechanical systems that I use. Right, that said, I also have to tell you that everything we cover here today is general investment advice, and there's no specific or personal investment advice. That said, let's get into the session. And we will start off, as we always do, with the Dow Jones. Now, I've stepped out a bit here, and I'm looking at a chart here of the Dow Jones going back to, you can see the bottom left-hand corner. That is the, I'm just going to get rid of some of these side panels. That is the 2008 bear market, the GFC, if you like, and just get some more space on the chart here. And that is an uptrend that has been in place, and those of you who watch the secular bull market update that I gave in December, is that black line there was the breakout. That point there, which is April 2013, was the breakout out of the secular bear market, and we've been in secular bull market ever since. So that is, and I'm going to quickly go down and show you the same chart on the S&P 500. And you can see that trend. You can see the number of times that we've bounced along the upper trend line, then moved sideways into the median lines, approached the upper trend line again, the channel line, and then moved to the bottom, and then back up to the top. And this price action we've had for the last 2 years brought us close to the lower channel line, but we're now sitting probably just below the midpoint. In fact, I'm going to keep this pinned, just so I can get some analysis from time to time. So now what I'm going to do is we'll zoom in a bit on the Dow Jones and pick the breakouts that we've been talking about. So bottom chart here, relative strength, let's cover that first. The Dow Jones in this period over here underperformed the S&P 500. This is the relative strength to the S&P 500, obviously a broader index, and more or less been matching each other. Not a straight line, but going sideways, which means they're more or less performing in the same with the same rise that we've had as matched each other. That's basically what it's saying. But the important thing here is this is the all-time high, previous all-time high, going back to December 2021, and here we are 2 years later, just shy of 2 years of breakout, sideways movement, pretty strong price action to get to the breakout. A little bit of a test and quite get all the way back down to the resistance, what was previously a resistance zone, which is now a support zone. And we've seen new highs in the Dow Jones. And the similar with the S&P 500. Now, when we last met on the 17th of January, the S&P 500 was round about over here. And it hadn't broken out. It was sitting in this sideways band, hadn't made a new high. Well, that breakout has since occurred in the S&P 500, which is quite key for the analysis we're looking at, because that was one of the indices that hadn't. Now, I'm going to skip through some of these because there's no new information here. What we're looking for in some of these breadth of market indicators is divergence. Where there's no divergence, I'll just step through because they're actually confirming each other. This is cumulative new high, new low. The previous one, sorry, this is a cumulative advanced decline. So we've got more stocks rising than falling, and there are more stocks making new 52-week highs than making 52-week lows in the previous chart. And nothing to report here as well. We're looking for extremes here in this breadth of market indicator, which is the number of stocks in the S&P 500 that are above their 150-day moving average. So that's saying that things are pretty bullish. 3/4 of the stocks are above. Right, now where we could look for some divergence, and this is the first little bit of a sign of some weakness, is, I'll just zoom in. Now this you've heard me say many times before, is this is the strongest correlation you'll find with negative divergence that you'll find against equities, and that is the US dollar index. It is uncanny how this, just zooming in and out over here, is how these two move in totally opposite directions so often. Not exact, the turns aren't exact. When I say the turns, I mean the reversals, either up to down or down to up, aren't exact, but they it is just amazing what the correlation is when the US dollar index falls and equities rise and vice versa. So the way that I do this analysis, I put a smooth index, a smooth rate of change indicator here, a trending indicator, and on this relative strength line. So this relative strength line is the ratio between the two, and this is just the raw price action on the same chart. So here we have the S&P 500 rising, and we've got the US dollar index falling. And what we have now for a short period of time is, and this is where the little bit of the red flag is, I'll just zoom in here, is we've actually got both going in the same direction. Now, this can happen for short periods of time, and one has to win out. So either equities have to fall to have the negative divergence with the US dollar index, or the US dollar index has to fall and the S&P 500 rises. So just a little bit of a red flag there to keep an eye on pretty closely. If the US dollar breaks out above this previous little high over here, peak, and rises strongly, then we are going to see equities fall. So just keep an eye on that. How long after, I don't know, but the correlation is that close that it would become a bigger red flag. Right, this is Russell growth versus Russell value. And one of the things I thought I drew on here, no, we haven't made it yet. I think it is. I should actually just look at it. Is that the Russell growth, I think, has just made a new all-time high. It has. That is a new all-time high in the Russell growth, and it is outperforming. So we had a little bit of a blip over here where it was underperforming for a period of time, but Russell growth has started outperforming Russell value, which is a risk-on indication. So that is why I put the green dotted line over here. The Ciroc has turned up again and started rising. So that is positive. That's bullish. The consumer discretionary is showing a little bit of weakness here against consumer staples. Found resistance at this zone over here, the blue zone, and is staying out of the channel. The down channel's come down to test it. What we would like to see here, this is a sentiment indicator, as was the growth versus the value Russell that I just showed you in the previous chart, is that we'd like to see more positive sentiment here going towards consumer discretionary, but not happening at the moment. But no sell signals yet, or sell in inverted commas, and that's a subjective sell, not a mechanical sell, and on that yet. So a little bit of underperformance there on the of the consumer discretionary against the consumer staples. Right, this is the put-call ratio. What we're looking for here is calls to outperform, or more calls to be bought than puts in that particular ratio, and that's what we're seeing here, declining. That squiggly line is a daily chart. The blue line here is a 250-day moving average, simple moving average, and I've put a trending indicator on the moving average, the 1 year moving average. And effectively, when this is falling, that's why I've got the green line over there. It's positive, and you can see equities are rising. That's when the signal occurred, and so that's bullish as well, also as a sentiment indicator. So more calls being traded than puts. That's going long both. Right, this one is the 10-year Treasury yield. This is a yield, and the next one we're actually going to look at the bond price as opposed to the yield. So this is the yield, and I think too much credence is put on the ratio between bonds and stocks, and you've heard me say this before, is that the correlation is nowhere near as strong as that of the US dollar v equities. So what we do have here, though, is you can see top right-hand corner here is that yields are rising. A little bit of a drop-off in the last 2 or 3 sessions, but definitely an uptrend over there. but we do, and that means, so we've had this falling over here, this indicator starting to turn up over here. But so what typically you'd want here is to see yields. So when yields are rising, as you'd see stocks falling, equities falling. When yields are falling, you'd see stocks rising. But now you've got yields rising a little bit over here as well. So they're both going in the same direction. So some commentators are saying that yields are going to win out, and that stocks are therefore going to fall. But this correlation is not strong enough in my analysis, my analyst view that is the case, because there are lots of periods you can go and find where yields have risen and so have stocks risen. And the same, looking at this is the 20-year, this is the ETF on the iShares ETF on 20-year Treasury bonds. So this is the actual bond price, as opposed to, and that's this line we're looking at, the red and green, where so as opposed to yield, is bond price v equities. So these should go in the same direction. So stocks rising, then also bond prices rising, but yields falling. Okay, so what do we see here? So the reason I'm showing this chart, this is the new one I've introduced to the session, is because people are using it, commentators are using it to say that, and I'll just zoom in over here on the right-hand side, is that they're saying that bond prices are falling, but stocks are rising, and it's a negative divergence, and therefore stocks should start falling as well. Well, over this period of time, and I've just done some raw analysis over here, and you can look at this, so you'll be able to get this chart when you download it. But there are so many times here in the past, I'll just zoom in a bit, where bond prices have fallen and stocks have risen. So what's happened then is, sure, stocks have fallen a bit. So the number of times where this divergence hasn't resolved in stocks falling. So you've had bonds falling for quite some time and stocks continuing to rise. But there obviously there's times when they go in the same direction. There's a time when they go in the same direction there. In fact, that's a bit of divergence the other way, with bonds rising and stocks falling. But I've just put on here where bonds fall and stocks rise. And you can see this goes on for quite some time. And the resolution of it isn't necessarily that because bonds are falling and stocks are rising, is that stocks are going to fall. You can see here is that bonds actually plateaued and then started rising in unison with stocks like they should. So it's really poor analysis in my view. There were all these periods of time, as I slide across here, I was showing you when stocks were rising, when bonds were falling. They're supposed to go in the same direction. Remember, yields are supposed to fall when stocks are rising and vice versa. So all those lines there are showing where they were doing the opposite. So that doesn't mean that now we've got this situation here that bond prices are falling and yields are rising a bit, that suddenly now equities are going to fall. But it is something to take into consideration, because there are periods where they do fall, they do go in unison, bonds falling, stocks falling. But that doesn't mean that it's going to happen on this occasion. So to me, that's a poor analysis, poor indication of what's going to happen in the future. And of course, we shouldn't buy into what's going to happen in the future. And when the noise happens out there in the marketplace and commentators latch onto something, it gets that void, the noise gets turned up, and they focus on one indicator and they turn it up, they ratchet it up, and they say, therefore this is going to happen, which is why it's so important to not know. And those of you that haven't done the 4-week training intensive, process plus mindset training intensive, Dave and I stress that, is that you don't need to know what's going to happen next in order to make money. And when you read commentary like this, don't take the notion and pour lots of emotion into it and then start making decisions as if you think you know what's going to happen, or that you think these people know what's going to happen. They don't. Nobody knows what's going to happen, and least of all us. So don't buy into that notion. Continue to execute mechanically. Right, the VIX, nothing to see here. It's down near pretty low areas, zone over here. That bottom line over here, that bottom channel line, sideways channel line is pretty extreme lows. So there's not much volatility going on there, which is a bullish sign. Right, the NASDAQ Composite is sitting below all-time highs. There it is over there, and that is the all-time high from back here, top left, and has not had a breakout to a new all-time high yet. So this is one of the indices that we really like to have all the indices above the all-time highs and continue to go stronger. The NASDAQ Composite's not there. However, we still got to, using the ratio that I have here as a sentiment indicator, this middle chart graph over here is measuring the ratio between the NASDAQ Composite and the S&P 500. And just on the right over here, you can see that this rising here, this black trend line that I put on this ratio, means that the NASDAQ is outperforming the S&P 500 at the moment, just short term. And this is risk on, that the fact is that over this longer period of time over here, I've got a smooth trending indicator here. And you can see the ratio rising more than falling or going sideways, is showing that it's still a risk on environment. And that's been like that since March last year. Okay, onto the SOX, which is the, this is the NASDAQ 100. So the NASDAQ 100 is above its all-time high, which was back there. It broke out above, moved slightly into the range only for a couple of sessions, and then broke out again and is still confirming that breakout. So that's strength. That's obviously market strength, and is of the four indices we looked at the moment, the Dow, the S&P 500, the NASDAQ Composite, and the NASDAQ 100, 3 are above and 1 is below. We're seeing a turn up over here of new highs and new lows on the NASDAQ, starting to rise a bit, which is good. That's what we want to see. The advanced decline on the NASDAQ 100, all in unison, no divergence there. So what we're looking for is a little bit of this, but there's no divergence, so nothing to report there. Right, the NASDAQ 100 number of stocks above their 150-day moving average, right up here, not an overbought zone yet. The overbought is the red, so it's below the overbought, but still very bullish and up at the 81%. On the this is the SOX, this is the semiconductor sector. I've put in since the last time we met this all-time high, and it's broken above that. So semiconductors are looking pretty similar to the NASDAQ 100 here, and it's risk on and above its all-time high. So that's positive as well. This is the All Ordinaries. There's the all-time high there, the dotted black zone, got just below it and is rising again. That is that's obviously bullish. And it is now we're starting to see, even though it's rising, this little period over here, it underperformed the S&P 500. So it has been underperforming the S&P 500 for quite some time, since February 2023, for a whole year. So looking bullish there as well. The Australian dollar is a little bit of weakness here on the strength of the US dollar. That's just happened that short-term period. A lot more weakness here than what the strength was in the US dollar, but nevertheless converse. Right, a couple of other indices to look at quickly. This is the Nikkei. The Nikkei there is the all-time high, that black line up there. That is from 1989. But what I did draw in here was this was an all-time high after 1989. It's risen above that quite strongly. And what we're looking for, and it'll be quite an historic occasion, is when the Nikkei rises above that black line there, which would be a new all-time high. And really, theoretically, it's been in a secular bear market since 1989, and that would then render a new secular bull market. So there's pretty long time that's happened, outperforming the S&P 500 shown below. Last index we'll look at is the DAX. So the DAX is above its all-time high. I'll just, sorry, that's got a little bit, it's a long, I haven't got all the data on here, so I've just got 25 years, and therefore it's just use those longer term trend lines that we have there. But the important thing is it's broken out above its all-time high, gone sideways to down. That's a little bit of a wedge there, and flag, and it's tested and broken out again and made another new all-time high. So this is all positive price action that's happening at the moment. We just need the NASDAQ Composite to reach a new all-time high, and then to really confirm the breakout here, which is effectively on the S&P 500. We back into the secular bull market is confirmed by this new breakout. Is for the strength really to come and be backed up by the whole market, as we need the midcap and the S&P 400 and the S&P 600, the mid-cap and the small-cap indices, to also break out to new highs. They're not quite there yet. I'm keeping an eye on it. When they do, we'll certainly show the charts. Right, on to commodities quickly. This is the CRB index, broken out of this downward channel and hasn't quite broken out above the resistance here. But I think that'll be on the back of oil, a little bit of a rise over the underperforming equities. So commodities underperforming equities is what that bottom chart shows me. Right, gold, another bash at trying to break out above its resistance. It didn't happen. It's a little bit of a downtrend over here, underperforming equities. And I know it's a big call, and I keep saying this, so just to remind you, that's my job, just to repeat myself and remind you of the big things to keep an eye out for. One of the big things to keep an eye out for is if gold breaks above its all-time high, and it's a strong breakout, because that would be one of the first signs of the end of the secular bull market. We obviously have to go back to price to confirm that in the actual indices, the equity indices. But this would probably be one of the first times we'd see it. So a number of failings to get through this all-time high, and it's going to continue to rack them up. 1, 2, 3, 4, 5, you could say. Typically it's fourth time breakout, and some of the people are saying, oh, this breakout's going to happen. It's the fourth time. I think we might see 5, 6, 7, 8, 9, 10 times. But my view is that it's not going to happen until the secular bull market is over. And this will be one of the signs, and that so we're keeping an eye on that for that reason only. Nothing to report on silver. Copper is broken out of its downward channel, and tested it, and then rising again. We really do need copper to get above 400 and to break out above that with strength, and to go and test its all-time high. And that would be, I think, what would cause one of the indications that would get small to mid-cap stocks to come into this as well. There's oil, the breakout of oil in this down channel above the upper channel line, and that's what's feeding through into CRB index, and a little bit of flattening out here against the S&P 500, but being underperforming. So keep an eye on oil. And Bitcoin, we had that sell signal, which I spoke about in the last session that we did 2 weeks ago, but hasn't really fallen through support, dropped out of the trend line here like it did over there, this channel line, and now just looking like it's trying to get back into it. But this is a sideways consolidation, if you like, and if this is all the retracement that happens after this pretty strong run-up that it had over this period over here, then that would be pretty bullish. So I'll repeat that. If this is all that the retracement is following that run-up, then that is pretty bullish. So keep an eye on Bitcoin. We've seen the trend indicator here turn up and on that price action. So this is not a mechanical signal. It's a subjective signal, but I know some of our clients do trade it. Is that crossover? We're looking for a crossover like that of the blue line over the green line being the moving average to smooth it. And similarly with Ethereum, has still not quite broken into this channel that we had. Yeah, it's getting close to, for maybe the next session, I'll redraw this channel line because it has spent quite some time below it, and it now has become a little bit of a resistance line. And also there's slightly different gradients here that I need to account for as well. This is uranium, and just zoom out and show where uranium is in the bigger picture. Certainly very, very strong price action. The uranium price over here relative to the URA, the ETF is showing that the ETF is underperforming, or the uranium price is outperforming the ETF, the ETF's not keeping up with it. So that's not a good tracker. ETF should track, but this ETF doesn't. But that's strong price action. And we're seeing lithium is going in the opposite direction, uranium going up, and you can read into that what you like. Iron ore is also rising. It's broken above this resistance line over here. The odds are it's broken out of that channel. I drew another little gray channel over there. This resistance line is broken above, and it's above this 130, 125, 130, which is quite a strong support resistance zone. Look for that to maybe retrace a little bit more and retest, and then this is typical classic technical analysis where we're seeing higher highs and higher lows. So this augurs for going higher, and testing this all-time high, which the last time it did that, it fell pretty sharply and down and fell quite a way. So we'll see if it goes up and tests that all-time high over there. I know that's the all-time high, but this has got more touch points, and then there are not many touch points, so we'll still leave that there for it to actually break above and stay above. And thermal coal is in a sideways movement here between support and resistance, getting down to support again, around about $120 odd. So that should, there's not many touch points on these commodity prices, and this is weekly data. So that's a strong enough one, I'd say, over here, that we'd want to see that support zone hold on thermal coal. Okay, that's what I wanted to cover. We'll go back to a theme. I just want to go to the S&P 500 again to finish, and I'll just clear this chart and just draw to your attention. I'll go to a monthly that we've just seen here strong. So this is going all the way back to 1998. This pattern that's occurred over here on the S&P 500 is a cup and handle. So I've gone to monthly. It stands out easier, where you can see there's the cup, there's the handle, and then a breakout. It hasn't got above there, obviously, because we are on monthly data here, so it hasn't registered. Tomorrow we'll see, at the end of the month, we'll see a larger bar at 4768. What's it on daily? Daily, it's 49, so there's another couple hundred points on there. But there's on the daily chart, there's the cup, there's the handle, and then the breakout. Classic technical analysis. Cup and handles are pretty strong. Patterns, I think is probably patterns is the right word for that. There's the zoom in. Any questions? Stunned you all this morning. Good morning, Colin. Colin did say good morning earlier, but that's the summary at this stage. We're looking for, it's bullish. One little red flag at the moment is the US, little bit of strength in the US dollar, the basket against equities. So keep an eye on that. That's the only thing to keep an eye on from a negative perspective. From a positive perspective, we keep an eye on the NASDAQ Composite to break out to a new all-time high. Looks like it's still a little bit too far away for that to happen in the next 2 weeks, but it may. It'll need a bit of strength to do that. And then after that, we'll look at mid-cap and small-cap indices, but the other main indices are certainly showing strength. So certainly it's on the side of continuing for some more bullish price action with what we've seen so far. Good. No questions. We'll end it there. Thank you for your time and attendance. We'll have this recording out this afternoon. And as always, I wish you consistent and objective and peaceful active investing and trading.